Been hearing our special discussion on the budget impact on markets with Neelkanth Mishra of Credit Suisse. You know, the one area of concern on the day of the budget was the bond market, where yields shot up quite a bit, and one often sees the next day the reaction being moderated, but we did not see a great moderation. Maybe it's because of the higher than expected borrowing calendar of the government, or it could be something else. But do you worry that there is going to be a sticky kind of a hardening of yields, which may make things difficult this year round?
Well, I totally worry about it. The good thing about our current bond market dynamics is that a very small percent, 1-2%, is owned by foreigners, right? So if the government is paying more, there are people who are earning high yield, right? So it's more a transfer than a cost. And but what it does do is it restrains the government and it also benchmarks rates higher, right? So there are many banks where the lending rates are earmarked to the GSEC yield. There are of course, if the government is borrowing at 6.97%, then everything else gets marked up, and that's the risk. And I think premature tightening of monetary conditions is a big risk for us, because the economy is just starting to heal. And here we have the term premium going to 2.9%. Now, why has that happened? I think it just reflects a lack of depth in our bond markets. Because see, I'm an equities person. My mandate is mostly, and I've been looking at equities for a lot longer than I've been looking at bonds. So perhaps the bond market is seeing something that I don't see. But the way I look at it, it is that the government is eschewing, it is refraining from doing wasteful spending. It has managed to raise its tax to GDP. If you see the debt to GDP going up, right? So FY20 debt to GDP, that state plus center, was 75%. Right now the government is at 87%. If you take government estimates for next year's GDP and the fiscal deficit targets and all of that. But if you adjust for the fact that there could be quite a bit of cash left over at the end of this year, and next year's assumptions are perhaps too low, and the fact that nominal GDP growth could be 13%, that 87 becomes 81. And when you see that 6% rise, why it has happened, 3% of that could be Capex. Now, if the government is spending and spending prudently, it is actually showing up on the ground in terms of better roads and drinking water and pipe drinking water for people, and quite a bit of that is just cleaning up of the balance sheet, right? So the government has decided to bring on budget what used to be off budget, and it has decided to clear its arrears, right? So export incentives on fertilizer subsidy arrears. So this is just a change of name. So instead of NHAI borrowing, it is the government borrowing, and therefore from a crowding out perspective, I suspect that the bond market is overreacting. And in fact, what this suggests is actually a plumbing problem rather than a gross savings problem. So even on the day of the budget, we highlighted to investors that the net borrowing by the government as a percentage of incremental deposits has actually not gone up that much. Because remember that the nominal GDP is now within 6% of its pre-pandemic path, right? So because with the 18% growth in FY22, without it would have been at, so if nominal GDP was 100 in FY20, FY22 without the pandemic would have been 123. With a 1.5% decline in FY21 and an 18% growth in FY22, that has become 116. So it's only 6% below. And therefore, the tax to GDP and a lot of the assumptions are actually far healthier than what the bond market has been looking at. And savings have actually gone up in line with the nominal GDP as well. Perhaps, in fact, as a percentage of GDP, they've gone up. So I don't see this as a crowding out problem. I think this is primarily a plumbing problem, that it's at the base of it, at the core of it, it's an illiquid market. There are few opinion makers who set it, and once the momentum goes against you, then the bond yield says, because everyone just refuses to buy. And I think as clarity emerges, as the government itself figures out, perhaps when it's setting up the second half borrowing calendar, that both states and center do not need to borrow that much, I think this problem of excessively high bond yields too early in the cycle will be solved.